Perfect. So the first rule in entrepreneurship is always be on time, right? So I'm starting about 10 minutes late, so I hope you guys are all right with that. But thank you very much for everyone for coming down today. Let me just start by giving you a little, I'm new to the program, new to the area, so I'll just give you a quick little background on myself. So I'm with a family office group that does venture capital investing, and I've just come down from our New York office to work on some portfolio companies here. My background is very unique in that I started my career as an entrepreneur in the music industry, in fact. I worked for some startups, started several companies, and then got into investment banking, raising capital for other entrepreneurs. And the one question that entrepreneurs always had, and the other people I met in New York were always asking, how do you raise money? How do you raise money? That's the biggest thing that keeps entrepreneurs up at night. So I dedicated my career into figuring out how to do that. And now I've been fortunate enough to actually go to the dark side and make investments on behalf of our partnership. We typically look for, about national financial companies, we typically look for early stage investments in the $2 to $10 million range. We like healthcare, financial services, and consumer products. So we've had a very long history of growing businesses and selling businesses in all of those sectors. I've been very involved both in New York, but also in Silicon Valley and now here in Florida. So quite excited to see a vibrant entrepreneurial community here in Florida. Hold on. All right, so now you know who I am. So who are you guys, right? So how many people here are students at FAU? Got a handful of students. Alumni? Excellent, excellent. Is everybody in the business plan competition and have, submitted business plans? And I understand you're going through a bunch of these different courses, right? So everyone's kind of going through the tracks of all the different things. Okay, good. So I think, what I'd like to do is just start out by talking a little bit about entrepreneurship and what you guys are tackling and what you're facing right now. And then we'll kind of get specifically into some of the things that we want to achieve in the presentation today with respect to your market opportunity, okay? This thing. There we go. So entrepreneurship. Entrepreneurship, I personally am very passionate about it, and I believe it's one of the things that is critical to driving our economy, to creating new innovations, and we view ourselves as investors as being financiers of innovation. So it's disruptive technologies, disruptive thinking, and typically entrepreneurship requires a very different sort of set of disciplines. It's a different mindset, and there's a different educational focus to learning entrepreneurship as a discipline. But the good news is that the result of that is, there's new products and services that are created all the time. We are an innovation economy. We need to continue to reinvent ourselves as an innovative economy. And I firmly believe that the future developments that we're all going to benefit from are the people in this room, are going to come from the people in this room and come from people that think outside of the box and do things differently. And let's not overlook the fact that entrepreneurship brought us things like ringtones. Let's not forget that entrepreneurship is a great way to generate wealth. And this is one of the things that entrepreneurs, I feel, typically miss out on, is that there's nothing wrong at all with wanting to build a successful business in order to generate wealth for yourself, for your stakeholders, and in fact create wealth for, the great news, let's look at Facebook right now. The whole story, everybody knows the artist at Facebook that's worth $200 million now because he painted a wall and took stock instead of cash. I think that's a wonderful thing for the economy, and this is one of the few countries in the world that you can actually do that in. And I think that's kind of what the American dream is all about. I'm actually from Canada originally, and I choose to live here because of these types of reasons. And in fact, my parents are sitting in the back here today, all the way down from Canada. So if you see a double-parked dog sled out front, that's probably theirs. So, so let's move on. But I think entrepreneurship as an endeavor is incredibly important. And one of the things that goes hand in hand with that is you know, how do you learn, how do you build this discipline, and how do you become more successful as an entrepreneur? And learning, I think, is a critical component of that. You know, everybody in this room, I think, has the potential to innovate and change and positively impact our world around us, and positively impact the people's lives that their companies will impact, their stakeholders, their employees, but people in the community, people that use their products and services. So I commend you for taking on, you know, that focus, and I think it's encouraging. And I think every day when you get up and, you know, sort of fight the battle and sort of figure out how to make your companies work, I think you should be, you know, really inspired by yourselves and the people around you that are taking the time to do this. I'm also impressed with the people that, you know, are coming here today to show up for this, because entrepreneurship can be a very lonely endeavor. I mean, one of my companies, I started out of a studio apartment on the Upper East Side of Manhattan, and you know, a Starbucks was my conference room, right? So, you know, you have to be able to build an ecosystem around you and reach out and you know, grow your own capabilities, because to launch an entrepreneurial business is one of the most difficult things that anyone can ever possibly do. So I commend you for taking it on. I think it's great that you're seeking you know, educational forums like this, and in particular FAU has really impressed me with their ability to, or their desire to create a program and look at entrepreneurship not as a symptom of teaching the core business concepts, but actually as a discipline in itself, and build education around that. So I think you guys are you know, really excited to have everyone here today. So let's just talk a little bit about your mission as an entrepreneur. So statistically, and this is a sort of back of the napkin statistic, it's actually much lower. Less than 1 in 100 business plans that are ever submitted to investors will ever get funding. Okay? Of those that do get funding through institutional investors, and the NVCA is the National Venture Capital Association. They have a wonderful website with a lot of statistics on it. They have, so I'd encourage you to go there. They have standardized documents for doing term sheets and operating agreements and LLC agreements, all that good stuff. So I'm citing some of their statistics here, that of institutional investors that report to them, 40% of the businesses that they invest in, so that's 40% of the 1%, actually fail. Completely go out of business, don't go anywhere. Less than 20% of the portfolio are actually going to end up being those success stories, like the Facebooks and things that we're talking about. Now, why do I bring this up? Not to be doom and gloom, but the reality is that every entrepreneur, 100% of entrepreneurs believe that their business is a good opportunity, right? So where is this disconnect between entrepreneurship and the vision that people have and the reality in the marketplace of what makes a company successful? And one of the things that I'd like to focus on today is actually, you know, bridging that disconnect through this tool of a business plan. So I understand there's a business plan competition, you're looking at creating deliverables in your business plan, so let's try to think today about how to, you know, get through our business and think about our business more in a more sophisticated manner, but also, you know, allow you guys to use this tool as one of your key differentiators for success. This is how you can stack the odds in your favor. So if you take the time to think through your concept and think through your business and articulate it appropriately, you can immediately put yourself in that 1 percentile, right? And that's the greatest tool that you guys have. A couple of things that just on an overall level of your business plan, I'm a big proponent. I see, you know, hundreds of business plans all the time. I think it's a playbook for a business that I get most interested in. Something that's executable, something that has defined milestones, something that's thought through, and you can say, okay, I know on, you know, quarter 1, quarter 4, 5 years out, that this believes that it's a believable trajectory for this business, and I know that they've thought through what the capabilities are they need to have in order to get there. The biggest point of failure for any entrepreneurial company is management, leadership, and execution. So any investor will tell you they invest in 3 things, right? Management, management, management. So it's all about execution, as it is in any business as a business concept. I mean, the things that typically inhibit anyone from being successful in a corporate environment is whether or not they can execute at a high enough level. And it's even more amplified in entrepreneurship because you've got a microscope on a business that you need to take to a whole new level. And not only do you have to excel, but even the great people are not even good enough. It's the exceptional people that really turn these companies into something. So the market opportunity in the context of this overall business plan and the tools that you have as entrepreneurs, there's a few things that you need to think about, and this is where we're going to start to hone in on the agenda for today, okay? So there's certain criteria that constitute a valid market opportunity, that it's a large and growing market. And I'll tell you the reasons for this. So a large market because it means that you can sustain competition, that there will be competition, and there's enough to go around for everybody to be able to carve out their niche within that market. But also not just that it's large, but that it's growing. Because if you're growing a business, and entrepreneurship is about growth, and let's be clear, I made the comment earlier about wealth, so let's be clear on there's sort of two types of businesses, right? There's a lifestyle business, or there's a wealth generating business. And lifestyle business is fine, and this is all part of entrepreneurship. I'm not discrediting it, but we're not really going to be talking about opening a dry cleaner today, right? We're going to be talking about typically companies that are going to want to have a growth trajectory, build large market share, and be a market leader and innovate. So that's a little bit of a difference. So in that context, you've got to be able to show that your company can grow, which means that your market, by definition, also has to be on a growth trajectory. Okay? So it's very difficult to grow a business in a declining market, for example. Not that it doesn't happen, but typically these are the basis that you want to go with. You address a customer point of pain. This is a really important, and we're going to get into this in a fair amount of detail. There's a lot of products, services, companies that are started out there that don't really have a market for their product because it's not addressing what your customers are really losing their sleep over. I made the comment earlier that I dedicated my career to figuring out how to raise money for entrepreneurs because that's their biggest point of pain. So you have to think about it in the same context with your market and your product and service. We'll get into that in a little more detail. A defensible position, everybody likes intellectual property, something unique. Basically that barriers to entry from your competition is one of the characteristics of your market that you need to understand. And then executable and with predictable outcomes. Doing a pro forma financial projection for your business is looking into a crystal ball. So it's never going to come out the way that you do it, but everybody spends a lot of time, and I encourage that, in trying to get it right. But if it's predictable because you've taken the time to make business decisions now without knowing what the outcomes are going to be, whether they're right or wrong. And it's typically the ability to make those decisions and understand your market that's going to make those outcomes even more predictable. And you're not going to miss your numbers by hundreds of thousands, it might be thousands. And in that circumstance, you're on the right track. All right, so, all right, I'm just going to use this. So let's just talk about what we want to do today. Okay, so we've got a fair amount of time. First of all, let's make this an open format. Ask as many questions as you would like. If there's a concept that we're talking about and we're working on and you'd like to go into more detail, please stop me. This is all about you guys. So I want to make sure that you walk away today with the information that you've come here to look for. So let's make it very interactive. There will be time for Q&A, but please just stop me and interrupt and let's get some open dialogue going. And then we're going to go through really 5 concepts today with respect to the market opportunity. We're going to talk about product pricing to your customers. We're going to talk about how to focus on the right market opportunity. We're going to define the market opportunity. We're going to do that in 2 ways. We're going to go from a macro level, which is top down, and a micro level, which is bottom up. The micro level is a TAM, or your Total Addressable Market, and we're going to spend a fair amount of time talking about this concept of TAM. And then we'll talk about how you can research it, where you go to get some of this information, and how you can sort of build out your market thesis. And finally, some strategies and tactics on how to articulate that in your business plan. Okay? So does anyone have is there anything they'd like to add to the agenda? Does anyone have any questions so far? Does this sound like a good? Okay, perfect.
Yes,
go ahead.
I've heard that it's difficult to get funding in this area. I mean, maybe Palm Beach, maybe South Florida, I'm not sure. Yeah. Is that true, coming from somebody that does this on a regular basis?
Yeah, I mean, one of the things I've found, so by way of full disclosure, I just moved down here a few months ago from being up in New York to focus on, we have 9 portfolio companies in the area here that I'm working on right now and some new initiatives. I've found a couple of things here so far in my limited experience. One, that there seems to be a really burgeoning ecosystem for entrepreneurship here. So this program in particular is really exciting to me because this is actually, even comparatively to some of the things that I know about in New York, they're actually very forward thinking about what it means to be educating with respect to entrepreneurship, but also aligning the community around it. So I know the program directors here have a lot of contacts with people that are investing here. I was introduced to this program by going to a venture forum called the Gold Coast Venture Capital Forum. And sat on a panel there. It's very well attended. And there are a lot of sort of private equity shops and some pockets of investment around here. It's certainly not Silicon Valley, and it's certainly not New York or Boston. But the reality is that regardless of the community of investors, raising money is going to be the most difficult thing you have to do in any environment. And I would certainly encourage exploring angel investors. We're a family office, for example, so we're not an institutional venture capital fund. There's a lot of groups like that around here. Challenges are very difficult to get in front of. Cool. All right, so let's dig into, they told me not to turn my back because my bald spot's going to come up on the video, but I keep doing it. So let's start with some product pricing and customers. This, I believe, is really the foundation and the building block of getting your head around what your market opportunity is in any business, okay? So your product. So there's a few different ways that you can view a product. You either have a product or a service. And I bring this up because it seems like a very academic concept, but in reality, you need to have that self-awareness about your business and really understand, are you selling a product or a service? And it's, at times, not the most simple sort of answer, right? It can be a very complex question. So when you're thinking about what it is, this is very much sort of like a self-awareness test, right? You've got to know, what it is that you're bringing into the marketplace, and really, are you going to follow that? Because there's also implications to your business plan and your business model. So, services can be sold very differently than the way that products are sold. So ultimately, your market opportunity is going to have a symptom in your plan, which is going to be your sales projections, right? So if you start at the beginning of what your product and what your product or your service is, then you've got the foundation to build on. Now, let's talk about this point of pain, because I think this is a really, really important, concept. It's all about your customer, right? So the market, in articulating your market opportunity, it's very much, and you'll see when we get into the TAM, it's very much about understanding who your customer are, where they are, what their capabilities to pay are, and then how you quantify that on a large enough scale to validate that you have an opportunity. I would also encourage you, as you're writing these business plans and putting together these concepts around your business, you prove it to yourself as well through this. I mean, the business plan, I think, is one of the most important activities that an entrepreneur can do, and I don't want to underemphasize that. But don't miss out on the plan part of the business plan. If you're taking the time to plan your business, prove it to yourself. I mean, you're an investor right now in your business, right? You're putting time into it, your own resources. And if you can't prove to yourself that this opportunity exists for your company, then you're never going to be able to prove to anyone else, right? So be very disciplined in the way you think about these things. Is it unique or is it novel? Not every company has to be something way off in left field and really unique. Let's take Zappos, for example, right? I mean, selling shoes online was nowhere near a new concept when they came into it. But what was unique and novel about them is they viewed that they were a service and not a product, right? Because they felt that customer service is what they could do better than anyone else. And also, that was unique in the market. So, you couldn't call Amazon's help desk and get someone at Amazon that had a record of your sales history and was empowered to actually make a decision on a return or refunding money for you. So that was incredibly unique, and they've become a wonderful success story for it. We're bought by Amazon. So this also plays into the defensible or barriers to entry. So intellectual property is something that everybody talks about as being really important. And it is, and IP is important, but it's very expensive. I mean, you're talking $50,000 to $100,000 for a patent if you're going to have one done properly by the right patent attorney that's going to be defensible. And a patent is only really as good as your ability to defend it, right? So it's great to have these patents, but if Microsoft wants to infringe all day, every day, they've got a war chest that you could never compete with from a legal standpoint. So don't get hung up on the concept that it's just IP that makes a business defensible. What I was just talking about with Zappos is incredibly defensible because they have a very sticky relationship with their customers. So it's really, really difficult for another online retailer of shoes, for example, to go and steal a Zappos customer away from them, because the customers love their experience, and that becomes their market. That becomes the barriers that they put up, and they fortify their position in the market. And then what do you compete against? There's no such thing as no competition, and we'll get to that in a little bit later. But be aware of not only who your competition is, but what your customers do in terms of their behaviors that are a viable alternative to what your product or service is. Okay? So we're going to come back to that concept in a little bit as well. Does anyone have any questions right now? So let's talk about this customer point of pain. I want to tell a story, a brief story about one of my first mentors. After I had to shut down my first startup, described to me a business that he was working for, or working with rather, and they felt that they had this incredible market opportunity. And they had one of those, a unique way to validate bills, currency, the paper currency when it goes into a machine. We see them all the time now in Coke machines and all that kind of stuff, right? Well, they felt that one of their key markets that they should go into were the casinos. So they put a whole bunch of time and effort together and went out to Las Vegas and started meeting with all the casino owners, because in their market research, the casinos can lose up to $1 million a day on fake or unvalidated currency that's being passed through their machines. $1 million a day. So they're going out there with this product and they're meeting with all the casino owners and ownership and saying, we can save you $1 million a day. And you know what they heard universally from everyone? They don't care. It's not a big enough number to make them even worry about it. These are casinos. They're bringing 200 a day, right? Or whatever the numbers might be in the market. But this is all about that point of pain. So if you believe that this customer really has this point of pain, you have to understand from them whether it's real or not. So, I could never fathom that losing $1 million a day is an acceptable business practice. But to get the decision makers and the CFOs of these casinos to even pay attention to their proposition, $1 million wasn't a big enough number to get them out of bed. So it didn't go anywhere. So, and then let's talk about this point of what competition is, or what your customers do. So let's look at it not necessarily in terms of who the other players are in your market, but in your market, if you're there and you have a product, and I'll tell you another story. There's things that your customers do and you have to understand their behaviors, right? So I raised some money for a company a couple years ago that has a fluid warming, it's a medical device, it's a fluid warming unit that goes right at the point of infusion and warms saline fluid or blood fluid to ambient body temperature. And the reason is that if you infuse somebody with a fluid that is too cold, and all of these have to be stored cold and shipped cold, you can actually cause someone to die from a fatal form of hypothermia. And it was developed by a fireman who actually killed someone by doing this to them, and was so disturbed over it, so there has to be a better way to do this. And it's a great product, and FDA approved, the military is their #1 customer. So we wanted to go into the EMS market. So we said, okay, we want to be in the back of all the ambulances, and it's portable and it's disposable, and we want to go with the patient from the ambulance into the hospital and follow them through their entire continuum of care. Because that's what's happening that the military is using it. It's in a forward echelon 1 military application. So it's actually the first line of triage that comes in, they get this device. So we said, okay, let's look at the EMS market. Well, as we did our research and started talking to the buyers, the suppliers, and then actually talking to the people that drive, or the first responders, the paramedics, we found out that what they do now is they take the saline fluid and they crank up the heater on the dashboard of the ambulance, and they put the bag on the dashboard. So you think about that and you say, okay, we've got this great device, but the reality is the device is about $250 cost to them. And they have $1,500 maximum per deployment to spend on all of the consumables for anybody that they pick up in an accident. So now we've got a disconnect, right? Because we think that this product is going to solve this problem, it's going to save lives. I mean, what more of a compelling point of pain can you have than saving lives, right? But they've got a free incumbent alternative to simply warming it up on a dashboard that there's no rationale for them to spend the money for it. So we actually went into the helicopter and air responders, because they have a larger budget. They're usually the first line of people that bring in new technology, so they consider themselves to be the rock stars of sort of paramedics. And you're also dealing a lot with cold environments as well, so going up to ski hills and these types of things. So they love it. We've got a huge market share in the air ambulance market, but the EMS market was not something that we could penetrate successfully because of all these dynamics to it. Okay. So let's say now that you do understand what your customer behaviors are and you've got, you validated and you believe, okay, this is where we want to be. So now you've got an issue of pricing, right? And this is a really important component to your market analysis for a number of reasons. One, obviously, how you price your product is going to have a direct correlation on how much you're going to sell, right? So there's all these sophisticated, I'm sure they offer courses here on, the elasticity of pricing and doing your regression analysis on how to understand, what's what's going to be what. But the reality is your customers will have a certain capability and appetite to pay, and you've got to figure out where you think that is in the marketplace. Now, you can also validate your pricing, not just sort of a finger in the air, but also think about what it is that you're mitigating, right? So for example, let's say that you want to create some efficiencies through, medical records is a great example, right? So you've got a medical records software, and you can go to a large hospital and say, you can create these efficiencies and all the great things and standardize, but also you can cut down your overhead costs by X amount of dollars because you're going to eliminate this entire group of people over here, right? Well, if you believe that's the point of pain and it's real enough for them, then the elimination of that group of people is going to have a direct dollar value to it. So one of the things that I always like to do is to sort of triangulate your pricing is to think about what you're mitigating and what the cost is to them. So for example, if you're saving them, $20 million a year in overhead, right? And if you've got a service, now you know that you can start to price that service below what their costs are, and it's going to be a cost benefit to them. Then you've got to make that arbitrage between their cost and their benefit large enough to encourage them to buy. Now the other fallout, the other third point in pricing is that, and this becomes your value proposition, right? So when you're going, selling someone. But the third point to triangulate on that is that now when you have a price, this becomes really important in your revenue projections, in your market sizing, and in particular when we're talking about our total addressable market. So all of these components, right, your pricing and your customer and their point of pain, these are the foundations that you need to start with in order to build your market theory, right? So if you have these components, think about what we're doing today as building blocks, right? And you're starting with one, but you can't get to the next one, or you're telling a story, right? And if you start with one, you've got to be able to accept that and have it done before you move on to the next, right? So a lot of times, I find, in particular in business plans, that on the market section, everyone's in a hurry to get to the big number, and typically don't do the research behind it, or validate it, or have any of the statistics that actually show that they put some thought to it, which means that it's just not really real and immediately discredit it. So these are, I think, the important places to start when you think about your market. So now, if you've got this product and customer and this pricing concept together, so now let's talk about being in the right market. So there's I'm sorry, yeah, go ahead.
Just to go back to
the
other point,
see if I can
and maybe you're going to be addressing this more about how do you validate that pricing for your customers? So you're going to give us some techniques on how to do that?
Well,
especially with the service. Yeah,
right. Well, let's talk about that a little bit because we're going to go into pricing in the context of coming up with market numbers. Now, actually pricing a product, it can be as sophisticated as you want to make it, right? But it can be very, very complicated. But typically, in particular, if you're a service, I would start really with those, sort of three components. Now, are you looking for like an equation that you can plug things into, or just? Just how to, how do we locate the service, for instance? We're different ones, but there's really different markets potentially, and services could be tailored to those markets. Right. But how do we figure out like how much they would actually be willing to pay? Do we need to go out and speak to them, or? I could not agree with you more. I think that's the first place, in particular, as an entrepreneur, and you're starting a business, and if you've only got limited resources in yourself as well, the best thing that you can do is go directly to your customers. So if you think you know who your customers are, right, and that's a great way because they may tell you that they're not actually going to be a customer of yours, and then you hear it, and then you understand, that you're either not positioned correctly or you're not thinking about your product or service correctly. But anecdotal feedback directly from your customers is the most valuable resource that you have. Now, we're going to talk about some of the techniques in order to, study your market and get some of this data. But I agree, you know, questionnaires, going out and talking to your customers, having conversations with them, getting price sheets from them of competition or understanding what they currently pay, and then thinking about it in terms of your value proposition, right? So, you know, what is there, are you addressing this point of pain for them? Is there enough value to this that they have, you know, unlimited resources, or is this a, you know, is it a low margin, high volume, or is it a high margin, low volume, you know, proposition to what it is? So, but yeah, talking to them is really great. Now, recognize though that every customer is going to say they want something for free, right? So you have to be able to sort of have the conversation with them and understand really either what they're currently spending and whether or not you've got a premium service above what they're currently spending that's going to take them away from it. So whether or not you're competing against the people that are already in the market, or if you're something entirely new and they're doing other things around it, like there's 3 or 4 activities that you could help create some efficiencies around, that would be where I would start. Okay, no problem. All right, so back there. All right, so put this question out to you guys. So how would you go about defining your market? All right. You want to take a crack at it?
Defining a market, I would say fashion.
In fashion? Okay, great. What about you guys? Ask the question, yeah.
Well, we are a service that could actually adhere to many different markets. So we're actually, that's one of the things we're focusing on right now, is picking which one to focus on and stick to that first. So right now we're actually looking at the restaurant industry.
Interesting, okay. Fashion, restaurant, what about you?
We're kind of between wholesale and retail. So right now we're focusing on department stores.
Department stores, okay.
Oddly enough on the West Coast. Not sure. So, yeah.
Okay. Now, are you also in fashion then?
Yes.
Okay.
We're not accessories.
Okay. So there's kind of 3 things that we've heard now, right? So we've got 2 people that are in the fashion industry but have 2 totally different views on what their market is, right? Which may be appropriate. And we've got multiple markets with one company that's trying to figure out how to be disciplined and stay in that one market, right? So this is one of the most critical things that you have to do in making a decision about your market opportunity, is really putting a stake in the ground and saying, this is where I am, this is the market that I'm in, and this is the position that we want to inhabit. So the biggest mistake that anyone that I see, and typically both from just a business concept, but also in particular in a business plan, is just picking a percentage of a market, right? So I said I was in the music industry, right? So, well, if we can just get 5% of the overall $5 billion music industry, you know, we'll be a $100 million company, right? Well, this doesn't work, okay? So let's get that out of our heads. Let's not think about, you know, that you know, here's a percentage of the pie. It doesn't take into account how you price your product if you're just talking about a percentage. So what people spend $100 million on that 5%. You know, if your product's worth $1, that means you need to sell 100 million products. Is that even feasible, right? It doesn't address any of the concept of how you go after your customer base. So it doesn't have enough sophistication in it that you know who your customer is. And it certainly doesn't have anything that's executable on that gives me any comfort, or anyone else any comfort, your own stakeholders or your own management team, comfort that you know how to go after and attack that 5%, and is it even real? You know, yeah, go ahead. Yeah.
I have a question. In my case, as a service, we target the market as a B2B or SMBs. When we talk to investors, sometimes they say that that's too large, that I need to focus on a specific industry or vertical. But the service that I'm offering is not vertical or industry.
I have the answer for you today in your total addressable market, okay, in creating your TAM. And this is not an uncommon problem, right? Because in particular, and in your case, if you're talking to investors, in particular sort of institutional investors, you've really got this tension between your conversations with them, because they want to see this large and growing market, and then you've got to be able to prove to them that there's an addressable market that's attackable that you can get today. So I'm going to show you, if you can hold on to that for a minute when we get into the TAM, ask as many questions you'd like, and I think that's going to be a tactic that you can use to sort of help get over that. Okay? So, talking about, has anybody heard of the Chinese glove theory? Yeah, okay. So this is my own sort of iteration on it, right? So this sounds like a pretty interesting market. So you've got a product that's a right-handed glove, okay? You've got 1.3 billion people in China. If 1% of the people in China buy your right-handed glove, that's 13 million right-handed gloves. If you sell them at $5 a glove, that's a $65 million company, right? You can't answer this, but does anyone see what's inherently wrong with this? Absolutely. Oh, you read my presentation? Right? No. That is exactly the point that I'm trying to make. So people get caught up in when you're defining your market opportunity, people get so caught up in quantifying it in numbers and percentages and being, market share, and that's all important. But those will be facts that are a symptom of doing the work, right? That isn't the work itself. So this idea of this, percentage of people, the big thing is you don't even have a product that's suitable, and people don't behave in that way. So it's not real. It can't possibly happen, right? So, and now let's take another couple examples that I like here as well. So, if you know what your market is, so let's take fashion versus retail fashion, right? So fashion as an overall market can be very attractive. Retail within fashion is going to have its own dynamics. So assuming now that you both have done the work and you understand what your product is and who your customers are and what their point of pain is and where you want to position yourself in the market. And a point of pain can simply be, I have so much money in my pocket that all I want is something that's trendy, and that's a customer point of pain. I mean, why do you think the new Rolls Royce is sold out, right? Because I got to be the guy on the block with the new car that, and that's a point of pain for me. That keeps me up at night when I'm that rich, which I'm not. So let's take these three companies, okay? And let's talk about, so assuming that the product's there and we know the market that you're in, now we've got to think about what you're selling within that market, right? So Apple, Rolex, and Starbucks. Computers, watches, and coffee, right? Pretty straightforward, right? Apple doesn't sell computers. They sell sexy design. They sell an affinity for a product. They sell a cult-like behavior in a retail environment. And I'm right first in line, right? Rolex doesn't sell watches. They sell a lifestyle, right? So their market isn't the watch market. You're not going to say, oh, okay, everyone who buys a watch, because someone who buys a Swatch isn't going to be the same customer that's going to buy a Rolex, because you're appealing to their lifestyle. And then Starbucks is all about the experience. And I would also add actually probably convenience, because they're on every corner. I mean, I don't know if anyone's been in Manhattan lately, but you can't walk 2 blocks without hitting a Starbucks. And they're just everywhere. But it's the experience, it's consistency. I know when I go in, sure, I'm going to pay $5 for a coffee, and I'm going to ask for all this weird foam stuff or whatever, right? But I know what I'm going to get every time. And it's also, there's a customer service component to it. It's always busy. They've got the cafes. And quite frankly, Starbucks was my office for years when I was starting, one business in particular that I started in my apartment. So it's all about that experience, and they got that right. So think about that when you guys are thinking about your, articulating your market opportunity, okay? You've got to understand who your customer is. You've got to understand what their points of pain are. You have to understand, what the dynamic is in that market and, how you price there. But you've also got to understand what you're selling, because at the end of the day, this is all about a transaction with your customer, right? So you want to be able to appeal to them. You want to have something that they like, but you also have to understand and go deeper than just saying that you're selling watches. You've got to understand that your watch and your market and that particular customer, what you're really appealing to and their point of pain is all related to lifestyle. Okay? So, now how do you validate this, right? So now we're saying we're in the right market. Okay, so we know kind of who our customers are, we know what our market is, and we know what we're trying to sell and what we're trying to appeal to, but how do we go about validating that, right? Well, there's some really important things that are going to end up giving you a quantitative output, right? So we're going to get to all the numbers things, but think about it qualitatively right now, okay? So if you've got this customer set, so let's say it's retailers in fashion, right? You've got different segments of retailers. You've got your high-end, you've got your big box, you've got your boutiques, you've got your outlets. So as you define that market of all those different characteristics, if your silo that you're playing in right now, and to your point about being in multiple markets, right, you have to be able to make the decision tactically and strategically which market is going to be right for you that's going to parlay into the next market. And then to answer your question about this big market that investors are always looking for, they're not necessarily looking for the big market, but what they do like is a product or service that can parlay into multiple markets. So if you've got one, this is why software is great, right? Because software can be reconstituted to go into all these different markets, right? And there's very low cost to do that. So all of a sudden, if you get $100 million in revenue in software product A, change the components of it and go into market B. Now you've got your siloed markets, but tactically, you need to think about now where your quickest opportunity is, where your highest return is. That's also going to allow you to build the foundation to go into those other markets. So for you, you're probably going to have to make decisions about whether or not you want to go. And I don't know your product, so just forgive me, but I'm assuming that it's something that's sold at retail. So it's either going to be high end or it's going to be high volume, right? So if it's high end, you probably don't want to introduce your product at Nordstrom's Rack. You want to introduce it at Nordstrom's, right? So okay. So the point is when you're validating it and you're getting this information about your market and about your customers, now you can see that the fallout of this becomes, now you can put some projections to it. You know how many Nordstrom Racks are out there if that's where you want to go, right? Now, when you know that number, it becomes very simple to put some of the numerical or the quantitative rather pieces around it. So how often do they buy? Who are the buyers? Who do you need to go to? What's their propensity to pay? What kind of terms do they look for? How often do they pay? What do they currently do? What are is there something new that you're introducing that already appeals to some of their customer set? Do you meet their customer set? So, and if you already have sales, the best thing that you can do, what we were talking about, is go to your customer, talk to them, and really understand what it is they're looking for. There was a company that I was working for, a technology company based out of the UK, one of my first, sort of entrepreneurial ventures. They hired me here in the US to launch a music kiosk where you can actually select full-length CDs or tracks on a server locally in a retail store and then print out and actually burn a CD. So again, we thought the point of pain was that we were eliminating physical inventory for the retailers, right? What you find out is that the retailers don't really care that much because they're selling the new Britney Spears album at a loss anyway, because every 1 in 100 customers that come in to buy the Britney Spears is going to buy a $900 TV, right? So, but the point I'm trying to make about talking to the customer is that Best Buy was our first customer. So I spent months in Minneapolis on site with them, with their technology people, with their retail people, with their marketing people, with their, and was there basically almost like an in-house person. That was the only reason that we had actually got any traction, is because we built that relationship with them, and we were able to make decisions about what they wanted, because they're going to want the world, right? They don't want to pay anything for it. They want it yesterday, and they don't want to have any of the hassle, right? So but that's not realistic. You can't do that. So you've got to be able to push back enough to understand, where your boundaries are as a business, because this is your business. You're running a business. You're the business owner. You've got to make those decisions. But also now you've got the intel, and you kind of know where they want to go. You know the things that they want to do. And when you have the ability to customize and sort of and service some of those demands, you can have a wonderful opportunity to build a very long-term relationship as well. But it's also a great way to get anecdotal feedback, like we were talking about, on things like pricing. And if you're coming to me saying, hey, do you want to be part of this business or be involved in it? And you can tell me, I talked to 10 of our customers and they all think that they're going to buy on a monthly basis at $900 a month, and they'll sign a 1-year contract. That means you've done your homework. How can I disagree with that, right? Okay. So knowing what you're selling, we just kind of covered this actually. But who your customers are, why they want it, what they're going to pay, getting that research, and we'll go into some of the research tactics in a little bit, but those are all really the key components that you have. And the whole idea here is that at the end of doing all this work, you're going to have a very buttoned up, very succinct section in your business plan that says, here's what my market is, and then you're going to be able to defend the decisions that you've made about your projections. So if you've got, now you know who your customers are, you know where they are, you know how you're going to sell them, you know how long it's going to take to buy. There's some products that have a 2-year sales cycle. There's some that have a 2-day sales cycle, right? These are all the data points that you need to think about when you're articulating your market. Okay? So now let's get into this definition of it, right? So we're going to start with, at the macro level, which is a top-down approach. And I'm going to use your example, if you don't mind, of the fashion industry, because I think this is a great place to start. So if you're coming at it top-down, it's pretty linear. It's pretty, straightforward. You've got a global number for what the fashion industry is, right? But to your point, when you're talking about that's not good enough, right? That's not good enough to understand what you are, what you do, or how you're going to get in there. But it's worth, it's worth having that research. And I would also add, just as I think about it, anytime you put something in a business plan in any section or any statistics or research that you have, cite it. You have to put in there, where it comes from, so it's validated, because there is nothing quicker to either, getting kicked out of a business plan competition or getting kicked out of an investors meeting than someone Googling a number that you put in your business plan that's not accurate. Okay, so make sure that your numbers are accurate. And if you have to create your own research, and I like creating your own research, I think that's one of the best things that you can do, because it means you're rolling up your sleeves and you're learning about your market. When you do, cite yourself as the source. Management believes. How can I ever disagree with what you believe? Management believes that we've got a $100 million opportunity. I can't disagree with that. So I'm going to ask you to show me the research and back it up. So start at a global level, because that, certainly, and when you are at that global level, that's where I would encourage you to think about trends, growth, sizing. Because if you're talking about the fashion industry, do you know how much what the global spend on fashion would be? It's going to be billions, right? I mean, this is a big market. Now, what I'd be interested to learn, and I'm not in fashion, so I don't know these numbers, but I'd be interested to know what's happened over the last 5 years, right? So at a global level, have we seen an economic impact, for example, because everything has, that is that number declining? So do I want to be in a large market? $5 billion market sounds really attractive, but it was $10 billion 3 years ago. Now I'm scared, right? So you got to think about these things in the context, particularly in the global level. Now, there's also a lot of great, and we'll go into a little bit more, but look for industry research, industry reports, analyst reports. PricewaterhouseCoopers always puts out great reports, industry reports, and then you're going to be able to cite sources that say, okay, if there is a growth trend here, you can get, you can find most of the stuff online, and some of it you're going to have to buy, pay for, or go to the library. I'm sure here they can probably have a lot of the stuff in the library. Find out what the experts are saying is going to happen to the industry. So is fashion projected to grow? Is it projected to grow in the sector that you're going to be in? So when you know those numbers, you start at a global level, then you can say, okay, it's a $5 billion industry. It's been growing consecutively at 20% per annum for the last 3 years, and it's projected to be a $15 billion industry in the next 5 years by Pricewaterhouse, right? That type of information is valuable. That type of information is important. But that's not going to make your business, right? But that's where you start coming at a top-down approach to defining the market. So also look for statistics that are published that will either prove or disprove your thesis about your business. And here's another point that I would like to make. Don't go at this trying to prove that your product or service is going to work. Go at this trying to understand whether your market can support your investment of time, money, and effort in this business. You understand does that make sense to everyone? This is a really important, sort of thing, because a lot of people will go at this and say, okay, I've got this, the next great widget, and are going to go out and do all kinds of research that are going to validate all the things that they want to hear, but they left out, the next chapter in the analyst report that says, by the way, there's a huge consolidation going on and the 3 public companies went bankrupt. Right. So you've got to do the work. Don't be afraid of what the answer is, because it's far better for you. I've had to close companies down, my own companies, other people's companies. Don't be afraid of the answers that you're going to get. Just be honest with yourself about what the answers are. And the market is one of the key factors that can derail your business opportunity at an early stage. Okay. So these are all pretty straightforward, the positive and negative, which we just talked about, but look for growth rates, look for demographic rates, look for migration patterns. For example, we have an investment in the senior housing space, and we're looking for markets right now where we want to see a lot of migration of retirees, because that's going to indicate that there's going to be a long-term growth opportunity in that space. And we get all that information from industry experts, from joining the industry organizations, from the reports that they put out, from our own research, from hiring consultants or getting experts around, but also a lot of it from the government and state websites. You know, there's census reports all the time. You know, average household income, average price of houses, you know, in the different markets, the average age, you know, unemployment rates. You know, these are all really important things to understand about your market. Go ahead.
As far as the census report is concerned, I mean, they kind of seem to be a few years behind. So how do you use that, especially with the way the economy's been in the past few years? You've got a census report that maybe starts, or that then ends right at the beginning of the downturn. How do you translate that into what you need?
Well, a couple things. So, one, it's just one data point in a group of data points that are going to make up your market opportunity, right? Two, everybody in the market's going to have that same information to go from, right? So you're not going to be going from a different set of data from all the other, you know, competitors or all the other companies that are in that space. So if that's the best data that everyone in the market has, then that's the data that everyone's got to make decisions on, right? So you're in the same position as them. But also, and in particular, I'll use the senior housing space as something, because we're doing a lot of research on it. And you're right, the census reports are about 3 years behind, right, before they actually publish them. I mean, imagine that the government doesn't do something, you know, in a timely fashion. But there's also, those census reports are also the base data of databases that third-party analysts and third-party consultants then take and start to extrapolate out those trends with their own analysis and models and projections. Some of it you have to pay for, some of it you can get access to for free, you know, some of it's a consultant, you know, it depends, but just don't stop there, right? If that's frustrating you, and it should be, and that's a great question, and I think that shows that you're doing the right things. But understand that that's the same condition for everyone, right? So everyone who's playing in the golf tournament in the rain, everyone's playing in the rain, right? It's not like one person has the advantage than the other, right? Then look for other ways and other avenues to either create your own research, look for third-party research that's out there, or look for analysts. One of the things that a lot of entrepreneurs tend to overlook are the number of consulting firms that are out there. I mean, the Bostons, the McKinseys, you know, they publish a lot of their reports. Although they're going to be a year old, probably they're not going to publish the new one because they're trying to charge me $5 grand for it, right? But they'll publish their old reports on there, and you can get a lot of really interesting information. Public companies is also a great place to look, the public companies that you're benchmarking yourselves again, because they have to put out all their information in their Ks and Qs, the reports that they put out. So you can start to see who they're citing as the industry experts are that go above and beyond what the government is doing. Okay. So now let's come at this the other way, because this is really, I think, if you take away one thing today, I'd like you to really think about this total addressable market. It's something that, you know, was introduced to me several years ago, and I use a lot. I think it's really a useful tool. So the total addressable market, I'm going to call it the TAM. Okay. This is a quantified revenue opportunity for your business. Okay, so this is not a market sizing exercise. What you have to do is segment your market, which we talked about, which is knowing your customer, knowing your pricing, knowing their behaviors, getting your market right, knowing where you play in the fashion industry, if it's big box or you know, I'm going to keep using this example because I think it's perfect. You know, so now you know what your market is. So you've got a segment. So what you need to assume is that in a scenario of no competition, okay, so if there's one product that's being sold in that market and one supplier, you know, now we need to think about how do we quantify that, okay? And your ability to quantify that is going to allow, I'm going to show you, is going to have the fall of your TAM. And this is exactly what you guys are facing in your conversation right now, okay? So, quantify your customers, number of customers. You know, who can you sell to? And the whole reason why sales, I'm using that for a reason in this, because this is all about your revenue opportunity. This is all about a sale. So your price, and this is why we talked about pricing at the beginning, Because if you're coming to this point now and you're trying to figure out your price, you're not going to get this part right. So that's one of the key foundations, right? So, what do you pay? We're talking about a revenue opportunity for your company, okay? So it's what do you pay? Who are your customers? How many of them are there? And then how much product do you think can be sold to them in the overall market with no competition, okay? So the characteristics we talked about, which is the willingness and the ability, is what you've got to go through and scrub. Now, how you reach them is one of the most important points, and that's why the word addressable is in this, right? So it's not just about having this list of customers out there, it's how do you reach them and you can address them, right? So you're probably not going, my fashion team here, you're probably not going over to, maybe you are, but you're probably not going over to boutiques in Dubai, right? So, although that may be your target market and you maybe want to go there, but that's probably not a good use of your time or your resource or what you're doing. So cut them out of your pipeline, right? And this actually becomes a cross between sales and marketing because you're doing some pipeline analysis here as well, right? Because what you're really getting to is who are your customers immediately, who can you go after, and what's the value of those customers. Now, this is an important concept, so does anyone have any questions at this point, or seem pretty straightforward? Okay. So, when you have that total number of customers, okay, and you should be able, and look, at the end of the day, the entrepreneur's job is to be the, evangelist for this company, and there's no one better suited for sales at an early stage component or an early stage life cycle of a business than the entrepreneur. I mean, you should own this and love it and live it and breathe it, every single day, right? So there's no one better to go out there. So you should know who your direct customers are, how you're going to reach them, and now you've got a pipeline of 500 customers, right? And you want to differentiate them by region, by all the characteristics that you have. So capacity to pay. So you might have 500 customers that are all within North America. Let's say that's your your target area. But you know that 100 of them, because you've read their if they're big retailers, you've read their analyst reports, you know that 100 of them are either going to consolidate, merge, go out of business, or under financial duress. That may not be the best place to start your activities in order to generate revenue for your business, right? So you take them off the list, okay? So now you've got a global list of, let's call it 450 potential customers out there for whatever your product is. And at the dollar amount, then you've got to project how much volume you think you can do through those customers. And now you've got a number that's actually going to show you what your market is, right? What your total addressable market is. Make sense? So here's sort of an example of going through that whole activity, right? And this would be something just sort of like some standard language and let me also say, every business plan should be different. Don't use the business plan software programs and things like that. And don't listen to anyone who tells you not to write a business plan. Every company's unique. It's got to be, you have to do the work and do the activities in order to have a fighting chance, okay? But this is the kind of way in which you can articulate it if you've done all this research and kind of gone through it, right? So globally, it's a $3 billion, business. Your products and sales pipeline, which is your TAM, right? You're projecting your demand. You have a pipeline in the U.S. demand for this product, and your research, which is the management team, indicates that you can do that. It's a total addressable market of $900 million a year. Okay, and then based on your initial customer commitments, right? That's an important line because it means you've gone out there, talked to your customer, and you're already trying to sell your product. That's a huge milestone in any early stage, business. And I would encourage you to always be thinking in terms of generating revenue and getting out there. So it's great to do all these, sort of things about the market and put in a business plan, and for the purposes of business plan competition, that's great. But a portion of your day every day should be spent talking to your customers and trying to generate sales, or building your product if it's not ready yet, because you could be in a beta or something like that. So you think you can get a 4% market share in the first 18 months and then grow that 30%, right? That's pretty, that sounds reasonable to me. I mean, I think it's defensible, right? What do you guys think? I think the only thing that would maybe be missing from that would be, growth rates within the global market. But typically, typically what I would do is that would kind of like be your executive summary of the introduction of your market opportunity as a whole section in the business plan. Yeah. Go ahead.
But how is that statement that you had in the last one exactly what you said not to do? For example, you said don't just take X% of a big market and say that's a market. Isn't that what you just did?
Well, we did it from the bottom up, right? So the X% of that market is a symptom of the customer base that you have and your ability to go after them. It's not a if only I could get 5% of that market, right? So the 5% is actually the output, not the input, right? So if you do the work, so that's a great question. So does that make sense to everyone, right? If you do the work and you start to build the numerical base of building this up, that number that becomes your percentage of your global market is just simply an output of doing the work. You're not starting there saying, okay, it's a 5% of this market, and I just want to be a 5% player in the automotive industry, right? Does that make sense? Did I answer your question?
4% of the 900 million, not 4% of the 3 billion.
So what it is that's a good question. So if you've got 900 million as your total addressable market, and you're going to get 4% of that, and that 4% is going to be based upon your customer pipeline. So you've got your 450 customers, and that the dollar value for all of those customers is going to equal 4% of the 900 million, right? So what you do is you go line by line each customer, and you say, okay, I think I can sell this much to this customer. I think they're going to be this kind of value to us. They're going to have, and then probably discount it for being a new company, and you'll end up with, whatever 4% is, right? You'll end up with that number. So the 4%, you're not backing into the 4%. The 4% is what it is because you've got the numbers associated with your pipeline. Does that make sense? Okay. Yep.
How do you define
Commit, that's a great question. So I'm going to answer that sort of in two ways, right? As an investor, okay, if you're coming to me with and you're saying I want some money. There's nothing that gives me more comfort in sort of checking my boxes because let's every investor's job is to find an answer, find a reason to say no as quickly as possible, right? It's only when they can't say no anymore that they're going to have a real conversation with you about what your business is. So if you go through, if you're sort of going through the boxes that I want to check, and you're going to say I've got customer commitments, then I can check that box and say, okay, there's either sales happening or there's revenue happening, or you have something happening where you're not just building a product and hoping that they will come, right? The other side of that, if I'm going to put my entrepreneur hat on, customer commitment for me is knowing that I can put them in that 100% probability close as a customer. So that's really a sales role. So entrepreneurs and everybody has a tendency to do this, to get caught up in, oh, this guy's going to order from me, and I'm sure I'm going to get this, and I think this is going to happen, I think it's going to happen. Well, if you've got a real customer opportunity with a real customer that's there that wants to buy your product or service, then you're going to have a real contract with them, and you're going to have to figure out how to take money and deliver the product or service. Until you're at that point, that is not a customer. So I would say, from an executive summary standpoint, or just putting the introduction to your market standpoint, if you can, put out there that there are customer commitments or things happening on the customer side, that's certainly helpful because it's one of those characteristics that any business needs to have. And it's not just that an investor needs to have it. I mean, if you think about it, if you've got a product or service, or in this situation that you were talking about, if you don't have customers, you're not going to have a business, right? So you got to ask those tough questions and put yourself in front of your customers and keep going as far as you possibly can in order to generate revenue from that customer. And if you're doing those activities, that's a box that you need to check as an entrepreneur because otherwise you're going to be here a year from now and you're not going to have any revenue and your company's not going to go anywhere, right? Did I answer your question? Okay. Yeah.
In the last slide you mentioned figuring a discount for market share for being in your company.
Mm-hmm.
Is that just
So,
sort of a...
Yeah, let's actually go into that if that's all right. Let me see if I can make this work. I'm pretty excited about this. This is pretty fancy stuff, right? So let's say you've got. Whoa. So these are your customers, right? You're going to have here a dollar value for sales for each customer, right? And let's call it, $10 for each customer. Okay? Which gives you a total pipeline, right, of $40. Now this is the total dollar value. My handwriting is atrocious, huh? Sorry. So this is the total, this looks like a grade school, youngest entrepreneur in the world. So you've got your $40, which is the total product that you can sell them, right? Now, what were the things that we were talking about in terms of the characteristics, right? So it's their ability to buy, it's their location, it's the sales cycle. So let's say that each one of these customers, let's say you want to take proximity as one of your criteria. So this guy's down the street from you, this guy's in the next city, this guy's in California, and this guy's in Dubai. Okay? Doesn't mean you don't have an opportunity to sell to them in terms of your addressable market, but as you're thinking about, and this is now really sort of sales pipeline management, right? So now you've got 10 and 10 here, okay? So you've got your $20 that you can sell. Now of those two, of the 20 that you can sell, you're going to be in a different state of negotiation with them or discussions with them or communication with them. And what you typically want to do is put some type of a percentage to that to say, okay, I think this is going to close. So I've either got a 100% probability or a 0% probability, right? So let's say none of these are 100, right? Because you still haven't got them as a customer yet. But let's say that you've got, a 50%. 50% probability here, right? And let's say you've got a 75% probability here. And let's call this the discount. Wow. Yes, that says discount. So let's consider that your discount, right? So in fact, it would be the inverse in that. So if you have a 75% probability, then you're going to discount it by 25%. Make sense? So you've got $5 here and $7.50 here. Okay? That $12.50 becomes your sales pipeline, but it's also your addressable market, right? Because that means that if you do all the activities that you say you're going to do in your business plan, if you reach your milestones and you're executing, you've got your product right, you've got your customers right, you know you're in the right space, that means that there is a probability that you can generate $12.50 in revenue in the immediate future. Is that helpful? Yeah.
If that's the discount, that's the probability that you're not going to close the sale. So is it $12.50 or
Yeah,
is it different?
So what you're going to do, and this is where I made the comment about the the startup discount. I mean, typically, if I'm going to see a set of projections, right, that a new company is going to send to me, you're just going to discount it right off the bat and say, okay, I'm going to take some percentage off of this, and if it's a 25%, it's not very sophisticated, but if it's a 25% discount on whatever the revenue is for this company, then I'm going to evaluate it in terms of our return expectations of being a lower revenue number that company can achieve. And the reason you discount it, I'm going to get to I know I'm not answering your question directly, but I'm going to get to it. The reason you discount it is because of all the risk factors and all the ratios that I put up. That's why I started right at the beginning and said 1 in 100 businesses ever get through this first stage, right? And this is part of the reason, because there's so many moving parts to it, there's so many components that you need to execute on. So there's going to be a discount, and that's what I meant by the startup discount, right? Now, in terms of this sort of pipeline management, there's a number of different ways that you can do it, right? But when you take your customers and put them into a sales pipeline, and you have a result coming out, it's usually a probability that you're going to close, right? So it's usually the 75%, in there in terms of pipeline management, right? But I was using this as a discount ratio to say, okay, if we discount it by 25%, that $10 in potential value has a value of $7.50 to me, because you're going to have the probability of a 75% probability that you're going to close that sale. Does that?
How do you figure out the probability?
That's a great question.
Especially if you don't have any of these there.
Yeah, that's a great question. So, a couple of ways to go at it. There is literally just the math that I talked about from the sort of investor side standpoint is literally like, 20 or 30%, and it's whatever I choose that day, just based upon what I think, about the management team. Now that's what we do sort of on our side, right? Because it is relatively impossible to get right to that number and say every time I can plug in an algorithm it's going to be 25%, 30%. The best way to do it is what you said you probably don't have, which is either historical data or close ratio. How many customers do you have to see in order to get to? This is actually good too for our addressable. Oh, here, let me try this fancy thing. All right. So this is your, that's a funnel. Kind of looks like Butthead a little bit, right? Beavis. So you've got all these different steps through a sales pipeline, right? And you're going to put in a universe of customers, right? So you're going to have, so let's call it 100 customers so that I can keep the math easy, right? And then as you put 100 potential customers into the pipeline, there's different inflection points that you're going to have to hit in order to move them through the sales process, right? So the first one, so let's call this like, prospecting, right? So you're prospecting here, and of that 100, and this is one of the things to answer your question, that if you don't have this data, you can start to think about how to create it, but you can also talk to either, contacts that you have in the industry or customers, or you can start to articulate this with doing some of your own research. But let's say that the industry that I'm in, the market that I'm in, for every 100 customers that I go out there and I send an email to, or I put a phone call in, or I meet at a conference, for every 100 of those potential customers, I can prospect out of that 50 of them, okay? So that means right off the base, 50 of 100 that I talk to just aren't going to respond to me. They're not going to come back to me. They're not going to talk to me. May have met them at a conference, and then you're going to have your own mechanisms for when you kick them out of the, you don't want to, spend time dealing with them over and over again, but let's say it's 50%, okay? So that means that you've got 50 customers that you're going to have a prospecting with. Now, of those prospecting, let's say one of your, and this is going to be unique to each company, right? The activities that you go through to sell are going to be unique to each company. It's going to be, if you've got a product, if you've got a service, you've got to think about what your sales cycle is, and there's going to be a different time component to that as well. But let's say for, just generic, from a generic standpoint, let's say that the prospecting, you go through prospecting, then you have a first meeting, then you have a proposal, and then you have a sale. Okay, so let's just say those are the 4 activities that you have to go through, right? So you know that you have 100 up here, which means that 50 are going to be put into your process, okay? Now to take that 50 and move them down to, this is a little easier. Meeting, sorry. I would spell all this out, but it's just pointless. It's not really anything. So of those 50, right? Let's say with your experience, or what you're going to predict, and you're going to have to make an educated guess at this, in particular if you're new in the market and you're just starting to sell and you're talking to new customers. Well, let's say that you can assume, okay, half of them are going to like the pitch meeting, they're going to like the presentation, and they're going to say, okay, I'll take the next meeting, right? So now you've got 25. Now, think about what I said though, is you've got an actionable outcome from that meeting that you can quantify. So you know that in order to get a sale done, you've got to take them from a pitch to a meeting, okay? Just generically, right? So in order to get to the meeting, that means you need to have the meeting scheduled, right? So what you can start to do is put in here, what all the different activities are, and you can put a date in here, right? And you can say, okay, I've got a meeting scheduled now on February 10th. Okay? That's going to be, and I know that if I get the 25 people, and each one's going to have a different date. Now you see what I'm doing, right? As you start to run out all these data points, and now you're going to be able to have, on a time and value basis, what your addressable market opportunity is from a sales standpoint. Okay? So if I move the 25 people over there, I've got the activity, so I could see at any time, I could open up at any time and say, okay, I know I've got I've got my 25 customers that are all getting ready for this next meeting. Okay? Then I know that I can start to add, percentages of probabilities to this. And there's a probability that they're either going to move to the next activity, or there's a probability that you want to discount the value of what their contract could be, right? Based upon how far they are out, right? So getting the sale, that's 100%. Yeah, that's 100% probability that you get a sale. When you're right up here at 100, you've probably got a 5%, right? Now what you need to figure out in your business is how does that probability change, right, over time? What are the activities that you need to do, right? These are all the activities here, 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 and here that you need to do in order to get to the sale. And then what is the percentage or the ratio of each activity, right? So we've got a 50% ratio here. We've got another 50% ratio. And let's say that 10% of them go to the proposal stage, right? So, and we'll round up and just say that you've got 3. So then of every 3, you get 1 customer, okay? Then you've got $1, let's say your product is worth $100, right? Well, then the numbers will work out all the same. Based upon that probability, then you've got $1 in revenue, 3, 25, and 50. But you're going to take your discount or your probability, and you're going to apply it to this dollar value, because that dollar value is at a 100% close ratio at each stage. So what you're going to say is, based upon kind of going through all those activities, you're going to say, okay, I know now with my business that of those 50 people that are in there, I know that only half of them are going to move over, so I'm going to discount their revenue value as a customer down to 50 cents instead of $1. So I'll cut it in half.
You need to do the discount to each phase, except for.
Yeah, I would do the discount here in each phase, right? Because the discount ratio here is actually, well, think about the inverse. The discount ratio here is actually 0, and this is 100, right? So at 0 discount, you get your full dollar value in revenue. At 95% discount. Wow, I could not make this worse. At 95, your dollar value in revenue in your pipeline from these 100 customers is actually only worth 5 cents. So if you have 100 customers at a 95% discount because they're so far out in your sales cycle, that's only worth 5 cents in revenue to you from a projection standpoint. Now, the other thing that that's really interesting here, you need to talk to 100 people to get 1 sale. So from a time management standpoint, from an execution standpoint, and from managing your own activities, if this is your business and you need to talk to 100 people in order to get to 1 sale, if you're not out there talking to 100 people every day, you're already shooting yourself in the foot of getting that $1 revenue. Okay? Everybody looks a little spent from that one.
If you have multiple revenue streams,
Yeah.
say for example, wholesale and retail,
Sure.
that you could actually sell to a wholesaler or you could sell to a retail place,
Mm-hmm.
you have to do this sales funnel separately.
I would do it separately, yeah, because, and think about what we were talking about earlier, right? You've got all these. This is very much about the customer characteristics in your market. This is still all. I mean, this is a sales symptom, right? This is a symptom of doing your work. This is the output, right? But you know who your customer is. You know what they buy. You know when they buy. You know what they want to pay. Putting all that together, if you have 2 different market segments, it's very unlikely that the characteristics of those customers are going to be identical in both of those segments. And when you guys are thinking about your different markets that you want to go into and you want to start to go into, this is going to be a great exercise for you to go through. Because you could find that market A means that you need to go out and talk to 100 people, which means you need to go to some conference and spend $10,000 and go there and find these 100 people. But market B, that could have the same dollar value, maybe you only need to talk to 5 people because it's a different sales cycle, right? Then you're validating your product, you're getting some customers, you're generating revenue, right? And that's really the goals. Yeah?
For the purposes of the business plan, you don't have to put all this data in the business plan.
I would not recommend putting this in the business plan at
Just the
all. This is
research
a
part.
yeah. This is the research part, which is a perfect segue into our next section. I think yeah, okay, good. So yeah, this is absolutely the research and the work. The business plan. I love doing business plans. I love them, but always think about the business plan as sort of sitting on top of all these building blocks that you've put together, right? So in order for you to come up and I think you asked the question about, or I think the young lady asked the question here about the what seemed like a sort of a conflict between what I was saying and then the text that I put out there. That's the great example of what we're talking about. Is if you do all this work and do all these building blocks, you can distill up to its a pure number or a pure value what your business opportunity is. And that's really the point I think I'm trying to make, is that you can't just start with that number and make your business fit that number. All of these building blocks and components need to be put together in order for that number to come out. Does that make sense? Okay. So I would not recommend putting this in a business plan at all, but I would recommend that if you have a sales pipeline and you've done these activities and you can point to any positive things that are happening to validate your business, to say, okay, you could certainly put in there and say, company currently has a sales pipeline of $50 million, right, or whatever it might be, or $100, right? And then if I challenge you on that, you can go through and say, well, here's how we thought about it,
That's
right?
what I wanted to know, is how,
Yeah.
if you're going to get questioned on where your figures came from.
This is one of those that I would cite in there and say, according to management research or company research, founder research, whatever you want to say, you certainly want to indicate in a footnote that this is work that you've done and created uniquely for your business. Because I'll certainly challenge you on it and want to understand. But remember this as well. I mean, these are, there's a healthy tension between practical execution on your business plan and sort of, research and theory, right? So this is something from a practical standpoint that you can use as a management tool as you're planning your strategy and your tactics on a day-to-day basis of what you're doing with your business. But on a theoretical level, right, you've got to prove that your business has this kind of opportunity. Does that make sense? So these things, you want to do them because it's what you're going to need to do in order to be successful. But then you want to articulate them in the business plan in a way to show that you've made some decisions. But the key thing is that you're not always going to make the right decisions. And again, if I take the perspective of assessing a business plan that gets submitted to me, I'm never going to view the content of that business plan in terms of being, accurate or real, or, what I am going to look for are, because it's never going to come, you can't predict the future, right? But what I am going to look for is, right or wrong, whether I agree or disagree with what's in that plan, I want to look for a management team or founders that have made decisions, difficult business decisions, without all of the right data, without the census reports, have taken the time to make difficult business decisions at an early enough stage that even if they're wrong, and it's really not about being right, but even if they're wrong, that demonstrates a real, sort of cerebral approach to their business, that they execute, that, there's an opportunity here that even if they are wrong, I believe in that individual and the research and the work that they've done, because I know they can figure it out, or we can figure it out together if it's not exactly right. So it's not really about getting the right answer. It's about thinking about how you come to these conclusions and then being able to demonstrate your business acumen in thinking through these because look, the 1 in 100 number, this is the most difficult thing that you can do. I mean, think about this. This is the thing that I always struggle with entrepreneurship as a discipline, in particular in an educational environment, right? I mean, you're asking an entrepreneur to be, CFO, Chief Marketing Officer, CEO, Chief Salesperson, Chief Technology Officer, government relations and industry relations. You've got to know all of the impact of the regulatory regime that you work under. You're basically asking 1 or 2 people to have all of the skill sets that people spend their entire careers dedicated to learning and developing to execute, right? And that's why these businesses fail so much, is because it's incredibly difficult to be good enough at all of those things to execute. And if I can take a quick segue before we get back to this, the best thing that you can do, and this is why I made that comment about it's a, a lonely endeavor and looking out for educational opportunities and things like that. The best thing that you can do is be very realistic with yourself about what your capabilities are and where where your weaknesses are and things that aren't, that you need help with. Go find those people. Don't expect that you have to do it all.
How do you pay those people?
Well, I mentioned earlier the story about the painter from Facebook,
Yeah.
right? One of the your best currency in your business right now is equity. So if you want to bring someone into your business, and that's the ideal story. Mark Zuckerberg did not have enough money in his pocket to pay a painter a few $100s to come in and do graffiti on the wall, so he gave him equity, and that's worth $200 million. So that's how you pay them. You pay them, you get them, and this is where the business plan, and I know I'm sort of coming off topic a bit here, but this is where I firmly believe that the business plan is one of your most useful tools. Is if you're trying to sell your vision and your story to someone else that's got this expertise that you need, if you're going to come to me and say, hey, Ross, if I'm a marketing guy, I need someone to help me with my marketing, I don't have any salaries to pay, we're a startup company, first thing I'm going to say is, okay, show me your business plan and I'll see if I can add any value to this, right? So it's not only a tool for investors, it's not only a tool to win, business plan competitions, but it's something to use to recruit internal and external people. It's a really, really important tool. Yeah?
Of those 100 companies you started talking about at the beginning, what percentage of those have business plans?
Of the ones that get funding?
No, of the 100 that you start. At the beginning of
Oh, the 1 in 100 ratio? Yeah. Well, look, all I can talk about is, my sort of pipeline and opportunities that come to me, and I won't look at anything without a business plan. So, as far as I'm concerned, it's 100% of them have a business plan. You'll hear, so there was a period of time, in particular in Silicon Valley, where a bunch of tech guys are going around with PowerPoints raising $10 million, right? But you know what? That's even more rare than actually doing the work and actually getting there and building a business and getting funding for it. So I would say, for the purposes of this discussion, that 100% of those businesses have a business plan. And part of what we're talking about today is that there's a difference between a business plan and actually doing the work behind it. And this is where, I'll bring it back to what we're talking about today with your market analysis. It's a very, very complex component to your business plan. And the difference, I would say the difference of those 100 ones, the difference between the 1 and the 100, is the 1 is the company that took the time to go through and think about their business and make those difficult decisions in what, in all likelihood, is a vacuum. That's incredibly impossible to do. So it's not about getting the right answer, but it's that company that made those decisions, thought tactically about their business, and did the work, and can talk to me in terms of their market using these different tools. So the plan's a tool, I think is the point I'm trying to make. So, okay, get those chicken scratches off of there. So let's talk a little bit about research. Okay. Talked about this earlier. Always cite your sources. Management believes, based on management research, that's great, but you've got to be able to show me or produce the research if I push you for it and want to see it. And then only state facts. I mean, the biggest issue that you're going to have in accepting, and that's actually a good way to describe it. One of the biggest issues you're going to have in talking about your market is accepting what your market conditions are that are out there, right? If you think about the story I was talking about the fluid warmer, right? I mean, those are facts, right? It had a negative impact on our business, and it had a negative impact on what the board was saying we wanted to do strategically with the direction of the company, but it's a fact. It is what it is, right? So it's your ability to be disciplined enough to recognize facts for facts, and then, change course or make other decisions based upon that. Okay. Different sources. I'm the biggest fan of questionnaires. And so here's a great tool for you in retail, right, in fashion. If you've got, and again, I don't know what it is, but let's say you've got a specific product and you know that you want to be in Nordstrom's, right? Put together a clipboard, go stand in front of Nordstrom's for a Saturday, and ask everybody, and ask people coming in and out if you can ask them questions. If it's, if your target is, if it's a woman's garment, right? Ask everybody that's walking into Nordstrom's, every woman that walks into Nordstrom's, if you could ask them 5 questions, right? That's who your customer is. That's who you're going to be selling to. It sounds like, not a very sexy thing to do, right, in terms of all this business planning. But I'll tell you what, if you send me a business plan and you've got in there that you spoke directly to 500 potential customers, and all of them said the one thing that I can't get is this color, and if only I could get this color, every one of them say that. I've got real confidence that you know who your customer is and that you're going at your product and your service in the right direction. So I'm a huge fan of doing that. Now, obviously you can't articulate your overall market and your TAM in terms of just having first-person interviews and questionnaires. So there's a lot of other different ways as well. And we did this is a little bit repetitive because we went off on a bit, but your competitors are actually also someone that you can get research from. And obviously you just need to think about how you approach them. But we talk to everybody. If we're in an industry or we're in a sector, we talk to everybody that's in it. We'll talk to our competitors, we'll talk to our suppliers, and you never know what type of discussion can come out of talking to your competitor and say, hey, maybe they want to do a joint venture with you. Maybe you're doing something unique that they can't do. Maybe they're going to give you a bit of information that is going to help you work on this, work on your sales funnel and say, okay, now I can actually think about what percentage, if you think it's going to take you, 6 weeks to close a client, and you're talking to your competitor and you're both selling the same guy and they're like, yeah, I really hate dealing with those guys because it takes me 9 months to get anything done with them, then your projections are off, right? The other point that I think I skipped over just on that pipeline to come back to it, just in terms of the timing, this also impacts your projections. Yeah, go ahead.
What's the best way that you found to kind of establish that initial contact with your competitors? I mean, especially for a startup business coming into a marketplace.
Yeah.
You may have something that you don't necessarily want to divulge, or that can be a scary conversation to have. And say, these guys aren't really going to tell me anything. Why would they? They're my competitors. What's the best way you found to kind of develop that relationship? So
in my experience, it's typically been at industry conferences or through industry organizations. So if it's fashion, or what industry are you in?
I'm actually in a number of different things.
Okay.
Helping a few businesses with their early stage planning.
Okay, great. So you're actually doing the session after me then, right? So, look, I think it's difficult. There's no one answer, right? Because it's a business conversation. You do have to be very careful about what the outcomes are, or the potential outcomes. You certainly, if you have something that's unique or a product or you've got some advantage, you certainly don't want to tip your cards and talk to them about what that is. I would just say with a caveat, if anything that you put in your business plan and you're putting out in particular to partners, investors, or other people, it's very rare that you're ever going to have something so proprietary or unique in there that anyone's going to be worried about it. The first turnoff for me is if you're asking me for a confidentiality. Just not going to do it, right? Now, in the context of talking to your competitors, that's a whole different story, because now you're actually talking to someone that could potentially have the resources to capitalize on the opportunity that you're talking about. And it's actually not even just your competitors. It's also vendors and third parties. I mean, I worked with a company back in New York that we hired a web development team to do an application for us for a music database that we were building, and they launched an iPhone app before we did. And here we are, a startup company, and I'm calling this guy and chewing him out and threatening to sue him. And we go to obviously in my line of work, I need a lot of lawyers, but it's a startup company. And at the end of the day, I went to the CEO and the founder and said, we got something, right? And we got all the free legal advice that we needed to. But if you can't write a $15,000 retainer check, this is a dead issue, So I think he resorted to attacking him in the blog sphere, I think it was. So the point is when you're talking to your competitors, there's a couple ways. I think industry conferences are really great because then it's usually a confrontational environment. There's a social component to it. You can always come at it with a third party as well. So have someone, either one of your investors or board members, or you as an advisor, or someone else, contact that competitor and say, hey, I'm looking at the space, or do something where there's no sort of direct line of communication if you're just trying to get intel. And then I always like to err in the favor of just being pretty straightforward. And if I'm reaching out to you and you're in the space and I'm in the space, if it's a big enough market, we can all play nice together or not. And if I've got an objective and I think you could add some value to that, then I'm going to have a tactic on how to have that conversation. One of the great outcomes of talking to your competitors is potentially these partnerships for a startup, right? Because but then you could even come at it and say, it's always good to position yourself in a position or put yourself in a position of strength, right? So you can always come at it and say, hey, we're about to eat your lunch over here, right? There's nothing wrong with coming out with that and saying, so this is what's happening. We've got the next best thing. We're about to eat your lunch over here. But what we think? It would be more valuable for us to partner together and go after this section, right? Bigger pie, more for us to share. Let's do a revenue share on it. You bring certain capabilities, I bring certain capabilities, and in particular as a startup, if you're looking at another company that either has distribution already in place or has, already has invested in some of the infrastructure that you need, server space even, or, there's all kinds of ways to leverage the different capabilities. And typically, if your competitor's a large company, they're not going to be set up to be as aggressive as you can in the market, right? So this was one of the things with dealing with Best Buy that I always struggled with the development team that was actually in London. Oh, we don't want the Best Buy technology people, VPNing into our server and blah, blah, blah. I'm like, what are you talking about? You think this is a battleship? You think all of a sudden they're going to care enough about, what we're doing to just do it themselves? We have $12 million in the company already, So does that help? I know I'm sort of going off anecdotally, but there's no really direct answer. Okay. All right, how are we doing for time here? Wow. It's already 11:15? Again, my parents. Okay, so let me burn through a couple of these. So integrating it into the plan. So now here's kind of the final piece, right? Oh, going my way. Think about it foundationally. I really like the whole building block component. In particular, if you're presenting a plan to me or for the purposes of the business plan competition, think about that document as a standalone document where you're not there to guide anyone through it. If you're not building the foundation of the story, you can't move on to the next concept, right? So I don't care if your product has all these bells and whistles if I don't accept or believe that the market is there for your product. Right? Does that make sense? So you don't want to come out right away and say, we've got all these great things and we can do this, this, and this, and it's the Swiss Army knives of iPhone apps and blah, blah, whatever, if I don't believe that there's a market for iPhone apps. So unless I believe that and you can prove that and there's that, that foundation, then I'm not interested in hearing the rest of the stuff. So in terms of when you're thinking about structuring your market opportunity, and that's why I went back right away to the big number, right? Because you have to have a basis to start somewhere. You come at it, it's like a figure eight, right? So you come at it in two ways. You kind of start here and you go around, you go up to the macro level, then you go down to the micro level, and then you come back, and you got a foundation on both sides, and now what we're talking about is the story in the middle, which is your business plan, right? No such thing as no competition. I talked about the ambulance heaters. That's a big, just don't even go there. If you can't find out who your competition is or what your customers do, don't ask me to find it out, right? You got to be able to do that. There's competition for everyone. Okay. Now, it's important, which I just talked about. So let's go right to the matrix here. So this is one of the ways that I like, and this didn't come out too well, I apologize, but this is one of the sort of ways in which I like to articulate competition in the business plan. So in your market piece, right? So now you've got, the big numbers, you've got the macro numbers, you've got an addressable market, you know who your customers are, you know what your pricing is, you know how you're going to get to them. These are all the components of your market opportunity, right, in your business plan. Now, one of the things that I typically will finish with is with competition, because there's actually a good thing in competition, which we were just talking about. You know, it creates opportunity, right? But it also means that you've got a market that's validated, because there's people there, right? I'm really scared of these new markets with very little competition, because I'm not the smart guy that's going to go figure that out, you know? And if it's that obvious, then how come someone else has? So it makes me sort of suspicious, right? So competition is actually a really good thing. And it's also a good thing in particular if you're benchmarking yourself against public companies, because you can get so much information on them. You know what their margins are, you know how much they sell their product for, you know who their customers are, you know how much revenue they did, you know what their historical growth trends are. You know, that's huge information for you to benchmark your business against as well. And you can also, want to find out, what do these companies look like? What are the characteristics of these companies? Because if you think about, if a company is very successful in your market and something that sells, you know, to your customer base, you can look at all the components that they have as a business, and then you want to think about how much you can make your business look like that business. Do they have regional offices? Are they local? You know, do they have venture capital backing? Or are they a startup? How many people do they have? How many years have they been in business? You know, do they have distributors? You know, all of these different components that you can think about, you get a lot of that information from your competitors just doing, you know, third-party research. But this I really like, because at the end of the day, this is your story and you're telling the story. So when you create this graph to put in your market section, you're the company with all the check marks on it, right? Full stop, that's what you have to show, right? Now, this is where you can put all the different components and different characteristics that you have. These are just generic examples, but the point is I love the matrix. It's easy to understand. If there's, you know, 5 things that are important to your customers, and there's, you know, 15 companies that are in your space, line yourself up against all of them on those 5 criteria. And if the 6th criteria is what you need to add on there to make sure that you're the only one with all the checks, then add the 6th criteria, right? Make sure you check all the boxes, and that kind of a matrix is really, really, really helpful. Then what you also want to be able to back it up with as well is, you know, the first thing that I'm going to ask for if I'm looking at a business plan with this in it is, okay, how much revenue does company A do? You know, how many customers does company B have? You know, how long have they been in the industry? You know, so studying your competition is actually really a terrific endeavor. Oh, fantastic! All right. So we've got a couple more minutes. Does anyone have any additional questions, or is there anything that we want to clarify? Yes, go ahead.
When you get the first introduction to the business plan,
yeah,
what gets you to turn to page 5? What's that first thing that says, yeah, I'm interested to continue reading?
To be honest with you, it's that it looks professional. It's that if I get something that has, you know, spelling mistakes in it, or the fonts are different, or the margins aren't set up right, or there's no page numbers, but it's not necessarily what I do look for that turns me on, it's what I look for that turns me off right away, right? You know, footers, footnotes. I mean, I just want to see something that's professionally done, right? Or you are the professional, you're the entrepreneur. It's got to be at least of a level, you know, and this is where I do like in an educational environment where you get forced to produce, you know, a lot of deliverables in school. It gives you that kind of discipline, and there's certain things, you know, I used to hate doing bibliographies. That was the one thing as a kid, as I was a student, that would drive me bonkers, right? But I'll tell you what, any plan that I look at or any plan that I put together has a really robust section on how to cite all the different sources on it and all the footnotes. Right? It's just got to look professional.
Right.
Does that answer your question?
Yep.
Okay. Yeah.
Let's say a small investor is willing to put $150,000 in a small restaurant.
Yep.
How much money is he looking to get back, let's say monthly or a year? How much money, how much percentage is he looking to get back?
Yeah, that's a great question, and it's going to take me just a minute to get there for you, okay? Because it's actually a very, very complex component to financing the business, right? And in fact, I think my next one's on financing entrepreneurship, or pitching my next session. I'm doing another one of these on pitching the venture capital, which we can get in. You'll see a lot more detail on that. So here's the point, okay? Restaurant business, right? The expectations of an investor or an owner or yourself in the restaurant business. Restaurants typically fall more in the lifestyle business than the wealth generation business, okay? So if it's something like a software company, then you start talking about percentages of equity, And then we talk about Facebook, and next thing you know, I got 5% of Facebook, and you know, we're all going out on my boat, right? But on a restaurant, there's high risk, you know, and there's very little opportunity on a single restaurant to expand your revenues on a meaningful fashion to provide, you know, an outsized return to your investor. Because investors are going to look for one of two things. If someone's going to give you $150,000 for a restaurant, that's probably someone who you're friends with, who you have a relationship with, who's investing in you and buying in you, right? They're not doing that to outperform the market. In particular with institutional investors, you know, all of these, they have a portfolio of companies and they have to outperform other private equity firms, right? So for you, it's all about what their expectations are. You know, there's a lot of businesses that have been started with angel money, and so it says, look, I don't even care if I get it back, just get your business up and running. The return on a restaurant, because it's a cash flow business and very much this sort of lifestyle business, is going to be predicated on distributions on an annual basis, not on an increase in equity value and capital gains over time. Okay? So what you're really talking about is how profitable you can run the business, and I would suggest that you probably want to do some type of a profit share or some type of a royalty or some type of a, you know, a distribution out to the shareholders on a, you know, quarterly, annual, or whatever basis. Set your expectations with your investor that they can, you know, that it's got a high probability of failure. Set the expectation with them that there's going to be no return in the near term. I mean, what you can't do is run a restaurant and then also be on the gun to deliver some type of ridiculous percentage return in a short period of time without giving you the chance to build the restaurant. So find out what their expectations are. If they want to have an equity position in the company, understand what that means, because all the assets and liabilities come with that, right? And if they don't want that and they just want to be a financial backer, a loan's probably the best way to structure that, with some type of a, you know, a moratorium on payments for a period of time, and then offer you out a distribution to get your principal and some return back. And interest rates are really low, so your hurdle rate's probably, you know, 10%, 5%, something like that on a loan right now, for a private loan. Okay. Any other questions? Yeah.
When investors look at your business and they look at the market you're going into, depending on how much, obviously, money you're looking for, is there a ratio there correlated? So, say the market share is $1 billion as opposed to a multi-million. Are they willing to offer you more money?
That's a great question. So here's a couple of things. There's no straight answer to that, but what I will tell you is, if you're talking to an institutional investor, when I refer to an institutional investor, that's a venture capital firm that's set up as a venture capital firm with a general partner, limited partners, and they have investors and they have a pool of capital. Okay, that's not what we are. It's our own money, right? So we're a little bit different. But as an institutional investor, okay, they're typically going to raise a fund based upon a market or a segment that they want to be in. You want to find out from them what their view is of that market. I don't know if we skipped over it, but there's this concept that I think I had in there where, you know, this talking to investors, talking to, you know, customers, you know, talking to, you know, anybody you want to bring into the business. It's never about what your view of the world is. It's always about understanding what their view of the world is, right? So the first thing you want to do is find out if they're in that sector, if they're in that market. They're typically going to raise a fund based upon A, how much money they can raise and what their cachet is, and B, their belief of what that, you know, niche is within that larger market. So if it's a fashion market, for example, or a fashion fund, you know, they're going to have some estimates on how much they want to be in the fashion industry, and they're probably going to raise a fund to correlate to that. Now, in terms of the amount of money that you're getting as a company, there's really two things to think about. One, how much do you need now in order to execute on your startup plan and get through your milestones? And regardless of what the, you know, sort of market size is, you want to have that market conversation, you've got to know that there is a minimum dollar amount that you can survive on, right? So I usually do like a startup, you know, schedule with a to-do list and a wish list, right? And the first thing I'll put out is the wish list. And if someone's willing to fund you for the wish list, then that's fine, but just don't try to do too much too fast. They're typically going to push back, and then you're going to say, okay, at a minimum, if I don't get $1 million, I cannot execute on the 5 or 3 critical things for my business. So regardless of what the market opportunity is, you know what you need in order to run your business, and that's the minimum. So if someone offers you a check for $750,000, you're probably going to have to say no, because you know you're not going to get there, and that you know, that $250,000 could make all the difference between being profitable and not. Second one is any institutional investor is always going to have a triage fund or part of their fund that's going to be allocated to making follow-on investments into any company. So one of the things that you want to ask and understand is what their propensity is to do follow-on investments, and if they do, is it typically 100% of what they've done before, or how much do they hold back? Because every company is going to come back to them at some point looking for more money. So they already plan for that. Very little correlation between market unless you're talking about the overall fund. And the real correlation that you need to care about from a market standpoint is what your revenue or your addressable market opportunity is. Because if that's not big enough, real enough, and you can't reach it, then it's all irrelevant anyway. Make sense?
Thank you.
Okay.
If you're seeking money from a loan versus seeking money from a VC or an angel, is the business plan and everything, both sides are looking for pretty much the same thing, right? As far as the business plan goes?
Yeah, I mean, it really depends. Probably not. The business plan, in terms of what we're talking about here, is an entrepreneurial tool. It's raising equity versus debt. It's getting, attracting talent and bringing people on and doing the work that you need to do as an entrepreneur. A debt provider, if you're talking about a bank, et cetera, they typically could care less. They won't even ask for a business plan. If you're going in to get an SBA loan or something, which I do think are great programs, it's going to be all about your personal credit and your creditworthiness and the history of the business. Completely different criteria, but that's also really cheap money too, compared to what you have to. Equity is the most expensive. To take investment in, that's the most expensive money that you take into a company, and that's why you have all of these bells and whistles sort of attached to it. But lenders don't, and I think lenders is actually, and if you talk about just this overall, we'll get into it in my other session a little bit more, but you talk about sources of funding. As an entrepreneur, you have to look at all these sources. You've got friends and family, you've got your own credit cards, your own creditworthiness, you've got lenders, you've got SBA loans, you have angels, you've got venture capital, you've got private equity, you've got third parties, competitors. There's been more than one occasion that I've talked to a supplier or a vendor in a new sector with a company that we're backing that potentially wants to float our receivables for a while and give us some cash flow in order to be successful because it's mutually beneficial. You got to turn over all those stones. Okay.
Sometimes they ask me, what is the valuation of my company? And I don't know how to do, because it's a startup. Can I use a TAM? Or there's a ratio that I can use in the TAM to apply to my valuation?
Valuation is another 2 hours.
Okay.
No, but let me answer a couple things. And it is one of these moving targets, and it's one of those things that's never going to be really locked down, right? But there's a number of different ways that you can come up with your valuation. Okay? Market is going to impact your valuation, or your TAM is going to impact your valuation because you can take sales projections from that and you can discount them back to a present value. And you can say, okay, if I've got a pipeline over the next 5 years of $80 million in sales, and I'm going to discount that back to a value today of, let's say, 40 million or 50%, and I'm going to add all these different variables in to discount it, then I can say, okay, I think my pipeline is worth $40 million. You can also say, that you've got the best way to come at it is with a revenue projection like I'm talking about, with a revenue number, and through looking at your comps, so other transactions, right? So if there are companies that you think you want to be like or mimic or emulate, how much were they sold? How much were they sold for? Who bought them? How much did they pay for them? And it's typically going to be a multiple of EBITDA, right? Or your bottom line, it's multiple bottom line, or a multiple of revenue, or some type of metric depending on what the industry is, like number of eyeballs for a website, or number of beds in the senior housing space, these types of things. And based upon that, there's going to be a market value for these certain characteristics. Now, what you need to do then is you need to convince me that you have those characteristics today in the business that are going to get you to that future market value. Okay? So the valuation, then, the biggest mistake that entrepreneurs make is being equity greedy at the beginning. Okay? Valuation is one of these things that is always really out of line with what the market is. Find out, if you're talking to an institutional investor, find out who their portfolio companies are, call the CEOs of those companies that raised money from them and say, hey, I'm talking to these guys, are they a good investor? What type of metrics do they look for? How did they value your company? Valuing a startup company is very much an art, not a science.
How do I factor in independent sales reps into the customer funnel?
Okay.
And I have about a team of approximately 30, but everything has just begun in the past month.
So the biggest thing that you need to think about with sales reps is what the cost is for you on a dollar basis, okay? Yeah, if it's strict commission, but how much does that commission cost you, right? So if you get in $100 in revenue and you know you need to pay out a 20% commission, then you get $80 in revenue, right? Then you still have to take all your costs of goods out of that, all of your SG&A out of that as well, and you're going to end up having $80 instead of $100 from that sale. So just make sure that you're taking that sales commission out at a high enough level so you have enough operating capacity. And then it's all management and tactics, right? I mean, you've got to have projections for them, you've got to have targets. You know, if it's straight commissions, you're probably not giving them certain quotas to make, but you want to get them somewhere. You want to be able to, you know, get data back from them. You want them to, you know, be doing activities that you want. So it's very much a management role for you now with those people, right? And they're either going to perform or not, and it's going to start with you, your ability to perform with them. So, yeah, I mean, we could talk a little bit more about some of those things as well, if you like. Go ahead.
Actually, I have two questions. In regards of structuring the company,
yeah,
and presenting this to VCs, I was informed that VCs really don't look at limited liability company.
Correct.
Look at, you know, corporations. So if I do start up as an LLC, for example, is that a smart move to start that now, or just go as a corporation?
Yeah, this is something that you know, entrepreneurs struggle a lot with, and I'm not a lawyer, so I can't, you know, sort of give you legal counsel, but I would come at it like this. Yes, institutional investors, venture capital firms that have a general partner and limited partner structure cannot invest in LLCs. And they can't because they have covenants with their investors, and they can't have a pass-through taxation structure because it negatively impacts the returns of the fund, right? So they have to invest in a corporation, okay? Now, a corporation is expensive to start up. There's a lot of, you know, cost associated with it as a startup. And you typically want to be an LLC so that you can have the benefit of the pass-through taxation as the owner. You can convert an LLC into an incorporation. You can't go the other direction. So I typically recommend start thinking about an LLC first, because it's the easiest to manage. And if you're having a conversation with a venture capitalist and the only thing they're worried about is your corporate structure, you can be an incorporation in 48 hours. Right? So that would never be an impediment to investing. And I would argue that if someone's coming at you and saying, I can't invest because of your corporate structure, then it's really a different reason that they don't want to invest.
Second question that I have, in regards of you know, making the business plan itself, and we are seeking funding, for example, is that something that we should note in the business plan?
Absolutely, and that's, you know, that's a different, you know, sort of section of what we were talking about today, but I would certainly encourage you to put, here's a couple of takeaways. These are really important concepts. One, always have the ask in your executive summary, right? So if you're building your executive summary at the start of the plan, so the gentleman asked me what I do look for in business plans that come in. You know, if I do get past the front page and I see that it's produced professionally and I want to read it, I got to be able to get the key information in the executive summary before I'm going to do any work. 1 to 2 pages maximum, right? And what I want to know is the summary of all the things that you've done and all the great work that you've put together in one very readable, succinct, you know, narrative. At the end of that, I need to know how much money you need and what you're going to do with it. Right? So if you're sending a business plan to someone to ask for funding, ask for the funding. Secondly, do not put your valuation in your business plan. People may coach you otherwise on this. I see no value in no reason to put your valuation in a document that someone's going to read in a vacuum. Valuation is always a discussion that you're going to have with an investor. If they want to talk about valuation with you, it means that they like certain things about your business, which means you're having a real discussion about getting funding. If you put your valuation out there, and as an entrepreneur, you think about it in a vacuum and come up with your valuation, it's going to be wrong, and it's going to be the easiest thing that I can go back to my partners and say, we don't need to spend any time on this because this guy wants to sell 10% of this company, and that's just not our model. Right? So I would stay away from valuation, but definitely put the money that you're asking for.
Now, I guess going back to what you spoke to him on, and seeking that funding, you know, we got figures that we feel that we need to keep afloat for the next 3 years. But we also got figures to keep afloat for the next 12 months. How do we know what's...
It's a great question. Think about it from, you know, your standpoint. Think about it from your standpoint as the entrepreneur, right? your immediate need is staying in business tomorrow, next week, next month, next year. It's very linear, right? You got one step to the next, right? As an investor, I like to invest on a milestone basis, right? So if you need something, if you need, you know, $5 million to get through the next 3 years of business, I have no interest in giving you the $5 million right now. What I will do is if I like it, and I like you and your management team, you've done the work, then I'll give you enough money to get through some key milestones, and if you make them, I'll fund you the rest of the way. If you don't, then I'm not going to lose the rest of the $4 million or whatever it might be, and we'll have a different discussion. So be very milestone driven. Milestones are a great thing to put in your business plan. I love Gantt charts. You know, these are the critical dependencies that we need to get through in order to reach our goals. This is the timeline that it's going to happen within, and here's the cost that's associated with it. Did that answer your question? Yeah.
Yeah. Could you elaborate a little bit more on the milestones? You mentioned Gantt charts. Are there specific milestones for the company itself that you would expect to see? Or are you talking about like market penetration milestones? What kind of things would you be looking at?
Yeah, that's a great question. And milestones are going to be unique to every company, but there's also there's sets of milestones that are to be universal, right? So revenue, right? Check that box. And think about it in terms of checking the boxes, right? So if I generate revenue, that's one of my milestones. So what I would put, and think about it in terms of what any business needs. Remember I said you've got to be all things to all people, right? You've got to have all these skills. Think about it in terms of the different silos that you need to execute on and what your business needs to look like to get to those certain criteria. And then those criteria are either going to be generic, like every business needs to make money, every business needs to hire people, every business needs customers, every business needs to buy stuff or create products. Every business needs to, you know, have some type of an innovation or R&D or some type of, you know, future plan. You know, these are, you know, key components. So you can map your milestones to reach those certain things, right? So if it's so let's take product development for example, right? So if you're building, you know, a piece of software and it's going to go live on the web, you know, one of your things is going to be a beta test, right? Now, in terms of, you know, charting it out in your milestones, you can get very forensic about that beta test. You know, you've got different coding objectives, you've got different skill sets you need to have, you've got different costs that you have to put out in order to get there. Then you're going to have different ways to evaluate the beta test. So your milestones could literally be like, you know, development team in place, you know, beta test launched, beta test analyzed, version 2.0 done, X number of registrants online, you know, X number, Y number of revenue, right? Keep it simple. But also, every one of these things is going to roll out and be very forensic in terms of your execution plan. And this is why I talk about the business plan as being a playbook or having a plan in it, right? You should be able to look back at that at any point of time in the life cycle of your business and point to exactly the month that you've got in your projections and know whether or not you're making it or you're not. Does that make sense? Okay.
I actually have one more question.
Sure.
I know you said you don't want to really talk about valuation in a business plan,
Mm-hmm.
but when you're typically a startup company, you don't want to give away the company in the first round of funding because you,
right.
Or at least that's my assumption. What kind of valuation would you typically, not necessarily valuation, but percentage of a company you would typically give away in a first round of funding?
So, investors typically want control or the ability to unwind the investment, right? Which means that they're either going to look for 51% or some type of negative covenants in the operating agreement that are going to give them some assurances that if things go sideways because of the 99% that fail or the 40% that I've already invested in fail, that there's some way for them to get in front of that and mitigate the failure, okay? Now, in terms of your valuation, it is entirely a function of negotiation and what the market is. So one of the things that you want to think about is the investors that you're talking to, what companies have they sold? Because this is all about selling a company, right? So we started an infusion therapies company in 2008. We grew it from 0 to $80 million in revenue within 3 years and sold 60% of the business to larger private equity. So we're still a 40% owner in this company. The exit was huge. It was a lot, you know. And we put in $2 million into that company, and we own 75% of the business. So the management team was incentivized enough with 25%, and they're all millionaires. So it's very much, and now our expectation's a little different because we're not institutional, right? So we like being at that early stage and getting a big chunk and running it, right? A lot of the institutional investors, they don't want to manage a business on a day-to-day basis. They want to be your board member. So it means that if you're going to negotiate valuation with them and they're bringing something to the table, it's not just money. And they, in order to get the valuation that they want, I think that they need to convince you that they're the right value-added investor and they can bring more value. So your equity, although smaller as a percentage, becomes accretive with them being on board. It's all about negotiation. Find out what the exits are. If you're talking to specific people or specific investors, find out who's in their portfolio. Talk to the entrepreneurs of those other portfolio companies. Find out how they approach valuation when they talk to them. Look at what exits they've had. Typically, any decent venture capital firm is going to put all of their IPOs online and all the companies that they invested in that they were successful with. Go research those. Look at what they sold them for. Look at what the multiples were, and then find if you can find out what the investment is. So if you know that they sold portfolio company A for $100 million and it went IPO or whatever it might have been, and you know that they invested $1 million in that company. Then you can start to correlate what that could have potentially meant as a percentage of what their return is, right? This is the other thing. Do not ever put in your projections investor return expectations. Don't put IRRs. Don't put ROIs on my money that's going in or an investor's money that's going into business. Don't even go there because it's going to be wrong, and I'm going to hang you for it later when it is wrong. All right? So don't put it in because it's fake. It's immaterial. You as the entrepreneur, you're not a professional investor. You're investing in your own business, but you're not the one who should be running all these sophisticated models in order to figure out what the return is on the dollar. Your return is based upon your ability to generate revenue and build value in the company, and then one day the value of that equity is going to be where you're going to get a big pop, right? So it's how do you value that today? Again, like I said, it's a whole other sort of concept, but I would just stay away from, because the final point, and I'll leave you on this, is that if an investor, if I'm now having a real conversation with you on valuation, it means I want to move forward. Which means now we're having a real discussion about you taking an investment and partnering with me.
I see shows like like Shark Tank where somebody will come up there and they'll say, okay, well we want 75% of your company.
Yeah.
And say, well I'm not giving away my company. I've been working on this for the last 3 years. It's it's my baby, and maybe not even 75%. Maybe they only want 35%, but they're still they have this sense that they want to keep full control of that company. And I don't know what.
So let's just remember one thing. Meetings with venture capital firms are never done on TV.
Right.
And it's good theater, right?
Yeah, sure.
And the fact is that, and this is what frustrates me about the show, we should do our own Shark Tank here. Because they take valuation as if it's just a 30-second point, and it's like number A, number Y on the list is a negotiation. It's never that simple, And the numbers that they ask for on that are usually quite egregious in terms of their percentages.
If you like somebody and you want to proceed, is it about 9 months when you actually will release some money, or?
Oh, no. It depends. Usually institutional investors they have no interest in running a process that's more than 30 days.
So 9 months, 6 months,
well, so that probably means that if you're talking to an institutional investor, probably means thank you for coming. So I know we're running a little late, but thank you. If you're talking to an institutional investor, it probably means they don't have money. So these guys, you got to understand with the investors that they have all their own dynamics and businesses that they run as well. And they either have a fund that they're investing from or they don't. If they do have a fund, then there's no reason for that process to take more than 30 days. Maybe 2 months on the outside, right? 9 months, it means that they're probably accounting for the fact that they need to go into the market, go to all the endowment funds, go to the pension funds, and raise another $100 million fund. That's a 9-month process for them, but that's their problem, not your problem. And it's your problem now because it means they don't have any money to invest, so you're probably barking up their own tree.
But you're talking about institutional money.
For us,
these are people that you said $2 to $10 million investments.
Yeah.
What if you need $500,000 to get to your first milestone?
Great question.
Angel investors,
angel investors. So we would fall in that sort of super angel category because of our capability to the size of checks that we're comfortable writing. Our last investment that we did took probably 60 days on analysis, and it was very much startup. They had, you know, it was a management team that we liked. It was a niche market that we liked. We needed to rework their entire plan with them, you know, go through that. So it was a lot more process than you guys would probably go through because you're already coming with a pre-baked, you know, concept. But that's also because we're a little different. We're opportunistic. We like niche markets, and we want to find the market first and then sort of build within that market. When we made the decision to invest, it got funded in 3 days. So we signed documents, we put it together, turned around with the attorneys, closed in 3 days. Well, look, I think, yeah, go ahead, sorry.
Yeah, so in regards of what you were saying about the LLC, the best type of investor would really be an institutional investor, would be an angel investor.
Yeah, I think if you're talking about the $500,000 number, what's happened is that the venture capital, you know, firms, they're no longer, the big institutional guys are no longer funding innovation at an earlier stage like they used to. So there's fewer and fewer funds that are going, and go on the NVCA. They've got, and go on PricewaterhouseCoopers, it's called the Money Tree Report. Great information on there. Deals that are getting done, what sectors are getting done in, the amount that's being invested in. There's another company called Preqin, P-R-E-Q-I-N, Preqin, out of London. They do a ton of private equity research, venture capital research. They're great. They're not cheap, but good research. To answer your question, $500,000, that's an angel investment these days. Unless there's a niche investor that's out there that goes very, very deep and very narrow in certain segments. So like I know a fund out there that only invests in cultivating new animal species for water, for water-based industry. So they're cultivating like sea urchins, right? And then they're doing like, you know, farming fish and like all these different, so they're very, they're one of the only guys that do it. They'll write a $200,000, they'll write a $50,000 check. I think they have like 8 or 9 investments. Their top is probably, you know, a couple $1 million, but that's their model, very niche, very narrow. There's probably some of these guys in fashion actually. There's probably a lot of these guys in fashion that made money in the industry, have funds or have a strategy that they want to do against, and very, very focused on what they think the emerging trends are going to be.
How do you find those people? Mine is confusing. How do you find that angel investor, you know, that their niche is you?
Well, so there's good news and bad news, right? So the good news is I made a career out of being the guy that people hire. I started an investment bank in New York to do exactly this. Because the bad news is it's very, very difficult to get a hold of these people. It's a very opaque market. In particular, angels and family offices, very, very difficult to get into. Institutional investors, venture capital firms, Google research, you can find everyone. Now, so how do you do it? Go to pitch conferences, come to things like this, go to entrepreneurial conferences, go talk to other entrepreneurs, find companies that are in your space that you want to be like or look like or think that your company could be, find out who funded them, call them up. There's nothing but, like, I love talking to entrepreneurs, and in particular, that's how I kind of got into this, is when I had my own company. You know, other guys would call me, they're doing other stuff, and we, you know, created this little sort of mafia group together, and we're all like, you know, I talked to this guy, I talked to that guy, and, you know, here's how, you know, you got to reach this guy, and trading in business cards, and we, you know, split up all the conferences that we go to in New York, and we'd have 5 guys at 5 different conferences every Tuesday night, you know, going to these different things. Now, that's New York, but here there's a lot going on as well. So I would encourage you just to look at, and then read all the, you know, just read all of the news releases that come out. You can go on, Twitter's great, there's all kinds of venture capital Twitter feeds that are just going to put out deals that get done. So I think we've gone way over, right? I'm sorry. One more question, and then, yeah. I'll tell you what, why don't we do this? Why don't we wrap up and I'll talk to you, stick around and talk to you after. Is that good? Look, everyone, thank you very much for coming today. I hope you enjoyed it.